Hello everybody and welcome to the Investment Mind. This is Hazel Isaac and today we are going to be talking about valuations. So what is this valuation? Everybody says the market is overvalued, the market is undervalued, the stocks are overvalued, undervalued. What is this about? We will discuss that today. It all boils down to this one ratio which is called as the price to earnings ratio, which we call as the PE ratio. What is this price to earnings ratio? It's nothing but your market price at which you have bought your stock or which the stock is at divided by the earnings per share. So price of the stock divided by earnings per share, you will get your price to earnings ratio. What does this mean? It means that if a stock is at, let's say, 100 rupees and your EPS, that's your earnings per share, is 5 rupees, you do 100 divided by 5, that means you get a number of 20. That means for 20 years, if you keep earning 5 rupees, in 20 years you recover your price. It means that. Now assume that this price, EPS, moves from 5 rupees to 6 rupees 25 paise. Let's say a 25% jump. What will happen? You do 100 divided by 6.25. Now your PE ratio comes down to 16. So the earnings went up by 25%. Your PE ratio came down by about 20% or so. So your amount of time to recover that same money, cost of yours, the price of yours has come down. So that is generally what a price to earnings ratio is. Generally, they say a higher price to earnings ratio means the stock is overvalued or the market is overvalued, and a lower price to earnings ratio means it is undervalued as such. Different companies have different valuations and different sectors have different valuations. You have to compare the stock price to earnings ratio with the industry price to earnings ratio. So what happens is every industry has an average price to earnings ratio, and you got to compare your stock vis-a-vis the industry in which it is. So according to that also you have a variation of maybe within the industry this is much more costly and this maybe another stock may be slightly cheap. So different companies within the sectors have different valuations. You got to look at that. You also have one thing which is very important, which I pointed out earlier. Growth rates affect the price to earnings ratio. So that means if you're having high growth rates and you can sustain them, your price to earnings ratio will also be high because they know that the company is able to grow, and with the higher growth rate, your PE automatically comes down. But yes, if the growth rates are going to be low, your PE also tends to be lower as such. Another factor which affects a price to earnings ratio or also your valuations which are higher or which affect valuations are, let's say, good management. Generally, FMCG companies tend to have a better or a higher price to earnings ratio because then maybe the earnings are more stable as such. MNC companies generally tend to have higher PE ratios. That's another one way of looking at it basically. So good management depends upon the sector. If it's MNC, background of the company, generally some companies are always valued at a higher price to earnings. So then you want to look at that vis-a-vis its historical valuations basically. Okay? Low growth rates or stagnant growth rates means you're going to be kind of low. Also, one thing which I want you to know, you may see one company with a very high PE ratio. That means either the growth rate is very high or it is a turnaround story. The EPS would have just come into positive and it's a turnaround story, and now the growth rate is really going to kick off. So there the PE ratio, you look at it, you will feel that it's very high, but actually it's a turnaround story and it's still coming from losses to profits, and from profits, small profits is going to go to big amount of profits. So that's one way of looking at it. One small thing I would like to tell you all is people generally talk about two types of price to earnings. One is your trailing PE and second is your forward PE. Now what is a trailing and forward? Trailing means on your particular last 12 months earnings, you get your PE ratio, that means your trailing PE. Most of the analysts talk about a trailing PE, and then you also have what these analysts speak about is a forward PE. Forward PE is, that means the analyst is projecting that this is going to be the earnings per share in the coming year. And they take that earnings per share and they divide it by the price, and that's how we get the forward PE. So depending upon the growth rate, and of course maybe a little variations here and there, but mostly the growth rate of the EPS, that's how you get your forward PE. Okay? That is one thing which is there. Just one thing please keep in mind, banks are not necessarily valued on your price to earnings, they are valued on price to book. So that's it for today, and thank you very much. Thank you.